There is a particular kind of financial pain that is almost impossible to see coming, and it does not arrive with a crisis or a market crash or a sudden job loss. It arrives slowly over years while you are doing everything you were told to do. You are saving. You are being responsible. You are setting money aside every month, watching the number in your account grow and feeling in a quiet and steady way like you are building something. And in many respects, you are building something, but what you are building may not be what you think it is, and the gap between what you believe your savings are doing and what they are actually doing is one of the most consequential financial misunderstandings of the modern era. To understand why, you have to start not with money, but with a concept that most people encounter once in a school classroom and never think about again: purchasing power. Purchasing power is not about how many dollars you have. It is about what those dollars can actually acquire in the real world at any given point in time. And the reason this distinction matters so profoundly is that the number in your savings account can grow every single year while your real wealth, your actual ability to exchange that money for goods, services, time, and security, quietly declines. This is not a theory. This is a measurable, documented, mathematically verifiable phenomenon that has been operating continuously for over a century, and it has a name. It is called inflation, and while most people are aware of it in a vague and general sense, very few people have sat with the actual arithmetic long enough to understand what it does to a savings account over a decade, 2 decades, or a working lifetime. Let us walk through that arithmetic carefully because the numbers tell a story that no amount of abstract explanation can fully replace. Imagine you save $10,000 and you place it in a standard savings account offering an interest rate of around 0.5% annually, which has been, for much of the past 15 years, a perfectly typical rate offered by large retail banks. That rate, after 10 years, your account will show a balance of approximately $10,500. You have gained $500. The number has grown. And if you check your balance and see 10,500, it is entirely reasonable to feel that your savings are working. But now introduce inflation, which over that same 10-year period, at a modest and historically conservative average of 3% per year, has been quietly compounding on the other side of the equation. For 10 years at 3% annual inflation, the purchasing power of your original $10,000 now requires approximately $13,400 to replicate. You have 10,500. You are not ahead. You are nearly $3,000 behind in real terms, and the account that felt like it was growing was, in the only sense that ultimately matters, shrinking the entire time. This is the core of the trap, and it is important to be precise about what makes it so psychologically difficult to recognize and respond to. Trap works because savings accounts provide what behavioral economists call a nominal anchor, a visible, stable number that our brains interpret as a measure of progress. When that number goes up even slightly, the brain registers a reward signal. We feel responsible. We feel secure. We feel like we are moving in the right direction. But the number going up and your wealth going up are two entirely different things, and in an inflationary environment, they can move in opposite directions simultaneously. This is not a flaw in human reasoning. It is a predictable consequence of how our cognitive systems were built. We evolved to track visible, concrete quantities. We did not evolve to intuitively process the invisible, continuous erosion of a currency's purchasing value over time. And financial systems, whether by design or simply by the mechanics of how they function, tend to benefit from that cognitive gap. The behavioral dimension of this problem extends further still, because the way most people respond to the discomfort of financial uncertainty actually reinforces the trap rather than escaping it. When economic conditions feel unstable, when headlines are negative, when markets are volatile, when the news cycle is filled with uncertainty, the psychological pull toward cash savings intensifies. Cash feels safe. A savings account feels controllable. The money is there, it is accessible, it is not going to disappear overnight the way an investment portfolio might during a sharp market correction. And all of that is true in a narrow and immediate sense. But the comfort of that safety is purchased at a price, and the price is paid slowly, invisibly, in the compounding erosion of purchasing power that continues regardless of how turbulent or calm the external environment appears to be. People who feel the most financially anxious are often the ones who respond by holding the most cash, and holding the most cash is often precisely the behavior that ensures their anxiety is financially justified over the long run. Now, it is worth being careful here about what this analysis is and is not saying. It is not saying that saving money is wrong. It is not saying that emergency funds are a mistake, or that liquid cash reserves serve no purpose, or that everyone should immediately move every dollar they own into higher risk instruments. Emergency funds are genuinely essential. Liquidity has real value. The ability to access money quickly during an unexpected crisis is not a financial luxury. It is a form of insurance, and like all insurance, it carries a cost, and that cost is acceptable when the coverage it provides is worth it. Question is not whether to keep any savings in cash, but whether the proportion of your financial life that is sitting in low-yield savings accounts has been deliberately chosen or simply allowed to accumulate by default, without ever being examined against the actual mathematics of what that choice costs over time. Most people have never done that examination. And the reason they have not is partly behavioral and partly structural. Structurally, banks have very little incentive to educate their customers about the purchasing power erosion of savings deposits, because those deposits are a source of extremely cheap capital for the institution. When you deposit money in a savings account earning 0.5%, the bank can lend that money out at 5, 7, or 10%, capturing the spread. The lower the rate they pay you, the wider that spread becomes. This is not a conspiracy. It is simply the business model of retail banking, operating exactly as designed, and the design is not oriented around maximizing your long-term wealth. Understanding that structural reality does not require cynicism. Simply requires clarity about whose interests each part of the financial system is primarily structured to serve. The historical record on this is worth examining because it provides a context that purely contemporary data cannot. In the decades following the Second World War, real interest rates, meaning interest rates adjusted for inflation, were often low or even negative, and the people who fared best financially during those periods were not the ones who maximized their cash savings. They were the ones who owned productive assets. Businesses, real estate, equities, things whose value could move in response to economic conditions rather than things whose nominal value was fixed while their real value quietly deteriorated. Pattern has repeated across multiple economic cycles and across multiple countries, and the consistent lesson is not that savings are bad, but that the form in which you save, and the proportion of your financial life that sits in each form, has an enormous effect on where you end up over a sufficiently long time horizon. What changes when you understand this is not necessarily dramatic or immediate. It is more like a quiet recalibration of how you think about the word safe. Most people have been taught, implicitly or explicitly, that saving money in a bank account is the safe choice and that other forms of wealth building involve risk. And risk is real. Investments can decline, assets can lose value, and volatility is genuinely uncomfortable to experience. But the framework that treats cash savings as the risk-free baseline and everything else as a departure from safety is missing a crucial variable, which is the risk of doing nothing. Keeping money in a low-yield account while inflation compounds in the opposite direction is not a neutral choice. It is a choice with a measurable cost, and calling it safe because the nominal number does not drop is a form of financial self-deception that the mathematics does not support. The shift that this understanding tends to produce is not a shift toward recklessness. People who genuinely internalize the mechanics of purchasing power erosion do not typically respond by gambling their savings on high-risk speculation. They respond by becoming more intentional, by asking for each portion of their money what role it is meant to play and whether the instrument holding it is actually suited to that role. Emergency fund? Keep it liquid, keep it accessible, accept the cost of that liquidity as the price of genuine security. Money you will not need for 5 years or more. Calculus changes significantly, and the question of whether a savings account is the right home for that money becomes much harder to answer in the affirmative once you have run the actual numbers. This is ultimately a story about information, specifically about the gap between the information that the financial system makes highly visible and the information it leaves largely implicit. Your savings account balance is updated in real time, displayed prominently, and designed to be checked frequently. Purchasing power of that balance is calculated nowhere in the interface. The inflation-adjusted return on your deposits is not shown on your monthly statement. Cumulative cost of holding your money in a low-yield account over a decade is not a figure that any bank will volunteer. That asymmetry in information presentation is not accidental. And recognizing it is the first step toward making financial decisions that are grounded in the full picture rather than the portion of the picture that happens to be most conveniently displayed. Where you go from that recognition is a personal question, shaped by your circumstances, your timeline, your risk tolerance, and your specific financial situation. But the recognition itself, the understanding that saving money and building wealth are related but not identical activities, and that the form in which you hold your money matters as much as the amount, is the kind of clarity that tends to change how people think about their finances for the rest of their lives. Not loudly, not dramatically, but in the quiet, compounding way that financial understanding, like inflation itself, tends to work.